Hi, I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. Welcome back to our weekly Market Insight broadcast, where we provide you our perspective on the week's top news stories regarding the economy, the market, your portfolios, so you can be better informed about your money. So with me today, of course, is our Chief Investment Officer, Aaron Tuttle. Welcome, Aaron.
John, I'm glad to be here.
And happy St. Patrick's Day to you.
Happy St. Patrick's Day.
I just noticed that neither you nor I have green on today.
Well, you say it's because we're in the green room,
We're in
right?
the green room, so if we wore green, we would disappear, from what I understand of how that technology works.
Maybe people won't like that.
They might like that. So what is going on in the market this week? Tell us
Sure.
What's on your mind.
We have air travel picking back up. The TSA sent out, because everything comes through tweet now, right?
Right. Well, in fact, I was on the airplane last weekend because I was visiting my daughter in Washington, D.C., but it seemed to be very well traveled.
Yeah, they are very well traveled. We're hitting new heights, and they're also pulling back some of the restrictions that once were in place. So we're hitting new highs, at least over the last year, on the amount of screenings from the TSA, which is very much good news. But it's going back to that reopening theme and some inflation fears that a lot of people have as we come out of the lockdowns and the recession that we have.
And how would that lead to inflation fears?
Well, people are beginning to spend the money again.
Okay.
So we had a lot of money that came in, especially from the U.S. government. Saving rates were high, specifically in the months where people received their stimmy checks, and they were saving those more than spending them because there wasn't a lot of places to spend them. With all this dry powder that's in the economy, and remember, that money was not offset by increased production. The production actually decreased because people were not working as much as they were. So that is stoking some fears of inflation. And then we also have
the stimulus bill.
Talk
to us about that.
For those that are receiving checks, check your account if you have not done so already. It should be there. So we had the new stimmy come out because the stimulus bill was passed last week and signed into law by President Biden. Of course, this has its detractors. I think the most vocal has been Senator Rand Paul. Now
this is an interesting comment, and this actually follows through with our long-term thesis, right, in terms of the economy and the market. So tell us more about this.
Well, certainly with Senator Paul following from his father's footsteps. His father is in the Austrian business cycle theory philosophy of how economies worked. He's made some really good calls over his time. It's a heterodox school, but one that we follow and understand because we think it has the best explanation for business cycles. So Senator Rand Paul is very familiar with the idea, and the whole thing is about the business cycle is actually caused by monetary policy through central banks. And it doesn't end well if you continue to try to grow the economy by just throwing money at it. So he's one of the more vocal people. He had an op-ed out with Fox News, and it was not tilted to, hey, Republicans do this better than Democrats. Criticism was leveled at both sides because you can't call President Trump's administration a low-spending administration,
No.
Right?
They spent a lot.
They spent a lot. And he was quoting in this op-ed the nonpartisan CBO. And the things that he was quoting should definitely cause all the politicians to have some pause in what they're doing. Right. So he's talking about the increase in risk for financial or fiscal crisis, and that in this situation it could lower confidence in the U.S.'s ability to pay down debt. Now, people would argue, well, we could always print the money. Well, that's the point, because if you continue to do that, interest rates because of inflation could move up. And remember, we're at near $30 trillion of national debt, projected to be $50 trillion by the first term of President Biden. And if interest rates were to move up, all of a sudden you would overwhelm the government's ability to continue to pay, and you're only paying the interest rate. And then you also have the inflation spiraling out of control if they continue to try to use monetary policy to solve the problem. So that's one quote, but if you continue to go into that CBO report, they said the reserve status of the U.S. currency is certainly at risk with the amount of spending, and by 2050, now, I think the CBO's projections are always way too rosy. They say we're always going to have a surplus so many years out, and we never see that surplus. It seems that anytime you make the argument that there's a surplus is a reason to spend more, right? That at 2050, the amount of revenue that the government is giving needs to own, 50% of it needs to go just to pay the interest. Now remember, the interest payment is no service provided by the government. It's not a transfer of payments to help with Medicare. It's not Social Security. It's not defense spending. It's just paying interest for people that own the home.
So this is just falling into our longer-term thesis about how the market is going to react because of monetary policy.
Right.
And that's why we're focusing on things like remaining financially self-reliant. So these are things that we know.
Right.
But then there are things that we don't know.
Well, there's still another component that we do know that's getting priced into the market, and that is
Tell
the
us about
infrastructure
that.
bill
Right.
that would be proposed. Now, President Biden is not the first president to say we need to do infrastructure spending, because we need to do infrastructure spending.
Right. I mean, we know that the roads need to be repaired. We
Bridges.
know bridges need to be repaired. We travel by air. I mean, airports need help.
And President Trump campaigned on an infrastructure bill. President Obama campaigned on an infrastructure bill, the shovel-ready programs that were going to be there, and we continue to not spend money there. And it's a place that needs to have some assets and some spending placed. And they're talking about a $2 to $4 trillion stimulus bill for infrastructure after we've already done $6 trillion in stimulus over the last year. Now, the administration has also stated that this infrastructure bill should have higher interest rates. So Secretary of the Treasury, Yellen, while she was talking about the need to do this infrastructure bill, pointed to the need to also fund the infrastructure bill with higher taxes.
So rather than just creating new debt, the idea would be to collect money through higher taxes.
Right.
But then they talk about passing this through the houses through a reconciliation.
Right.
And I guess my understanding is that if you propose a tax, not policy, that reconciliation can be a possible way to get this done.
And that's
what
how
are our thoughts on that?
That's how they got the stimulus bill through on the last time, was through reconciliation. And this senator from West Virginia, Manchin, has said that he's not going to go along with a lot of the big agenda items, and he kind of is that the linchpin to get things through. So that it slows down things. You need the 60 senators to get past a filibuster, so the Republicans with a 50-50 margin could always use the filibuster to stop a bill that was what they considered untenable and could not go through. There was a lot of hullabaloo yesterday because they're trying to get the filibuster removed. Senator McConnell came back and said, well, we'll do quorum on everything. What happened last week would be child's play on how difficult it would be to get the bill. So there's a lot there to try to digest, and there's a lot of political moves and strategies that are being employed. Now, this would be the highest tax rate since 1993. So back whenever Clinton was able to get some taxes. And what are they targeting? They're targeting raising corporate tax rates from 21% to 28%. A lot of the pass-through benefits from LLCs would come off. Obviously a target at the Trump tax cuts to remove some of those. But it's not just removing some of the Trump tax cuts. They're also talking about increasing tax rates for individuals making $400,000 or more. They're talking about
long-term capital gains.
Long-term capital gains. They're also talking about the estate tax, where whenever you got started in the business, whenever the estate tax was at $1 million and above, sold a lot of life insurance policies to deal with that.
Now, what about this wealth tax?
Yeah, so
talking about?
The wealth tax is probably the most would be the most destructive to the economy. And that a lot of people say, why would that be?
Yeah.
Well, whenever you want to tax somebody, let's take Bezos with Amazon. He doesn't have cash sitting around. His tax would be taxed on the value of his corporation. But that corporation is just reinvesting. That's capital that you're taxing. And the capital is the production component of our economy. It's actually what gives us a higher standard of living. The more developed your capital is, the higher the standard of living, because the more productive your employees are. If you have to then spend 2% of your capital just to fund into governments, which are more transfer payments, you start destroying the companies of Amazon, Google, Microsoft, and all these large corporations and their capital. Because remember, it's not sitting there as cash. They have to start making that into cash. So that would probably be the most devastating type of on wealth, would be a wealth tax. And it's really hard. Like, when do you tax? Every year?
Right, exactly.
What about, do you get a kickback whenever your wealth drops? I mean, shouldn't you?
Right. I would certainly want to. Well, talk to us about your next slide here, because this is an interesting thought with regards to taxes.
With that being said, I think Gunlack had talked about if the unlikeliness of taxes actually increasing substantially, because if we look at what has happened over the last year, 80% of the spending has been met with either borrowing or really stimulus through the Federal Reserve, or monetizing it. I think the political risk for senators to push out a big tax increase whenever they could just as easily go to the federal government or the Federal Reserve and have them print money and give it to the Treasury is probably more politically viable. So our take is that we probably don't see a huge change in tax policy. Another thing that I wanted to point out is the Laffer Curve, which says that you lower taxes and then all of a sudden you get excess revenue.
Well, this is what the Republicans point to when they say, well, we want to lower taxes because that's actually going to be better for the economy.
Right, so that this suggests otherwise, that the Laffer Curve, whether the Laffer Curve is correct or not, we're certainly not past the point when you lower taxes, all of a sudden revenue goes up, because each time they've lowered taxes, revenue
So what is this slide telling us then?
It's telling us that the government usually taps out around 20% of GDP and bottoms out at around 15% of GDP. That's the most and the least amount of money that the federal government tends to have relative to the tax code. But also, just as much as this Laffer Curve kind of doesn't square with the rhetoric of Republicans, neither does the rhetoric of Democrats, where they're saying we need to increase taxes to pay for this stimulus, which pays for itself. So the rhetoric just doesn't align with reality for either of the parties.
So you wonder whether any of those actually work, lowering taxes or raising taxes.
I think we would be better. I think we would be better served if we started to focus on the spending versus the revenue, because it isn't a revenue problem.
Right, it's not a revenue problem; it's a spending problem.
And look at the spending: $1.8 trillion during the 2008 crisis, and this one, which I don't think was anywhere near as bad as the 2008 crisis, we've spent $6.1 trillion. And we still have another 2 to 4 trillion possibly to go. I mean, the amount of deficit spending that we're doing is just, it's
That's
substantial.
pretty remarkable.
That doesn't mean...
That's only 25% that we spent back in 2008, 2009.
And it doesn't mean that all of the discussion that you and Chris had about deflation on the price is not something that still won't happen.
Right, but that's certainly one of the things that we're still going to monitor, because while we understand theoretically about the inflation effects, there's also that deflationary pressure. So we just have to monitor where that actually is going to lay out. But with the amount of money going into the system, it's making the deflation argument, I think, less impactful.
Well, you certainly have less deflation with the amount of money than you would have otherwise, right?
Yes.
Now, those are the things that we know.
Right. This is what I was talking about before.
Yeah.
We know these are risks. We've been talking about them. But
and the market is probably pricing those in, at least the probabilities. And there's plenty of unknowns, but we titled this Black Swans and Gray Elephants, because there are actually things that we do know. We're just not getting a lot of coverage. And I want to spend some time going through some of the things that we don't think are getting enough coverage and probably are not well priced into the market.
So tell us.
We won't know as while we're filming this, because we cut off our news feed just so we don't get distracted with whatever has hit the wire right away. But they're discussing at the FOMC the supplemental leverage ratio. That's a big.
So tell us what supplemental leverage ratio is. I actually know the answer to that.
Yes.
For our audience.
It's another example of when economists use very obscure language to say very straightforward things. It's the leverage that a bank is allowed to have. How much of their capital do they need to keep in cash as deposit in the bank that somebody can come and request versus the loans that they have out?
Okay.
So that is really the amount of leverage that the bank can have. And prior to prior to the recent crisis, it has historically been about 10%.
So let's just say, put that into numbers. So in other words, if a bank has $1 million, let's say, of this capital down here below the grass, they can lend out $10 million.
Correct.
So they're lending out 10 times more than what they actually have.
Right. And the lower this leverage ratio, the more unstable the system is. So if we had 100% reserve, then it would be a very, very stable system
So
for.
in this case, if you have that $1 million of capital in the bank, you can loan out $1 million.
Right. You could only loan out the $1 million that you have, and that would be very stable. But imagine what the interest rates would be, because you only have $1 million to make loans, not $10 million. So the interest rate would be very high in that. Very stable, but very high.
One of the words that we hear is fractional reserve lending.
Right.
So in other words, you're only in that first scenario where you have $1 million being able to loan out 10. You only reserve a fraction of what's actually out there. Where in this case, this is reserve lending, where you only are, where you're limited to whatever your reserves are.
Correct. And then during the crisis, they exempted the SLR, meaning that there were no longer any requirements to keep any reserves whatsoever.
I can just lend out
infinite money supply capability.
Money, and I'm just going to lend it out. We're just going to call it lending.
So they're talking about it. So it's set to expire. We think that they'll extend it, but they may not. And if they don't, we do believe the markets will kind of get a little tumultuous here. But know that the banks never did this, because you can go to the bank and get cash out. If they had loaned out everything, there would be no cash to get. So whenever you look underneath
that's one of the things that you hear from bankers, is that they're trying to find places to loan money. So even if they do change the policies, you say, they're probably still
well capitalized.
They're well capitalized compared to what they would have been had they loaned out.
And remember, we had excess reserves prior to this change. Right now, since there is no reserve requirement, there's no excess reserve, because they're not required to reserve anything. So we've kind of lost some of that data with the terms, but there was excess reserves. They probably haven't loaned everything out. They're probably well capitalized. Other than a market correction just based on something that's unexpected, it would be probably passed. But the other thing that people are not talking about is the measurement of the money supply.
Okay, so we've been talking about this in the last couple of weeks, because we now don't have data, but nobody's pointing it out except for us.
Very few people are talking about it. I think actually very few people. We were in connection with somebody else that talks about the M2, and they weren't even aware.
Right.
So the Fed has reported on the weekly growth of the money supply going all the way back to the Nixon administration. They've been doing this for quite some time. And they have recently stopped reporting, and then are now starting to report, but they're only reporting on a monthly basis.
Why would they do that?
I don't know, because if you can go back to the Nixon administration, before all the computers and all the ease, we shouldn't be going from weekly to monthly. We should be going to weekly to instantaneous. So what my question is, are they hiding something? And I think that is probably the case, because the amount of money that has been created, 25% of all the money was created over the last year. So I think the Fed is starting to slow this down. Now we know that the Fed continues to expand the money supply, because we don't have the funds to meet the spending that the government is doing. So right now we're confident that it is growing.
But my understanding too is that not only is it not being reported weekly now, when they report monthly, by the time we get the data, that's what, 4 weeks late?
Right.
So we're actually getting something 8 weeks late, and we were using that as a measurement before. So how are we going to adapt for that?
Well, we are back testing. We're doing some averaging, some other components, and we still get a signal, but we don't feel like the data is sound and the quality is there, because we don't know if there's been a bottom and what's actually happening under the hood week to week, just month to month. But so far, doing the back testing, it has given us a signal. But yes, paying attention to whenever the money supply starts to slow its growth is a big, strong indicator for us, and has proven itself time and time again that as that growth slows, the odds of a correction, a significant correction, increase substantially. So it's certainly something we want to know.
Haven't we heard things from the Fed, something like, well, the money supply doesn't really matter?
Yes, so Jerome Powell had said that recently, that it doesn't matter and that it's irrelevant. But the money supply is the raison d'etre. I can't do the French as well. My French teacher would be mad. But basically,
it is
there you go.
Raising the debt is the
raising the debt. I think there's an R in there, but it's the That's the whole reason the Fed is there,
Right.
is to monitor the money supply. If it's irrelevant, then the Fed is irrelevant. Well, that can't be true. So once again, we think that it's trying to hide what's actually happening, because at the same time, we had mentioned a couple of weeks ago, the CIA stopped reporting on other central banks' money supplies. So there seems to be a concerted effort, and we don't want to put our tinfoil hat on and get into conspiracy theory, but it seems odd in a world where information has become far more easy to obtain and more instantaneous, that we're going backward.
Well, this is not a political statement. This is our investment committee uses this as one of our technical signals for monitoring what we expect to happen in the market. So without this technical signal, now we have to think about what are we going to do in its replacement, because this is a specific measure that helps us to make specific decisions.
Right. And likely what we'll do over time, as we are less certain that the money supply is expanding at a rapid pace, we'll probably begin to hold higher cash balances in the cash hubs.
Right. That'll at least help to mitigate the risk of having a sudden drop-off that we're just not ready for.
So then it gets us to our investment themes. We still believe inflation risk is high. We still favor equities over fixed income. We like U.S. domestic markets over international. This value rotation has made us question that a little bit. We favor technology. I want to get into that, about the growth potentials of technology versus this rotation in value. And continue to have the other factors as well. When we look at price points, we
hit some new highs.
New highs. While the NASDAQ and the growth side is struggling and they're not participating, the value, the energy, the financials, and the other areas, as we have that reopening, back to that TSA statement of more screening.
Right.
That is driving the other side of the index, which has been really unloved for quite some time.
I mean, do you see this changing? I mean, or is this like maybe a short-term drop on the part of the NASDAQ and technology?
We were talking about this in the investment committee. We're a little bit of, though we agree, we think in different degrees on how this is going to affect. I believe that the value rotation is going to have a little bit more legs than just a quick head fake. I would not be surprised to see the end of the year value outperform growth. But when we look at the underlying companies, we think the growth story is still for technology, and why we favor technology.
Well, we've talked about that in regard to the ESG investing too, because a lot of the ESG initiatives really involve technology, right?
ESG has done really well because it forces them to buy a lot of technology companies. Technology companies have done really well, and that is where the growth story is. So probably the most promising story on the value side is in the energy sector, with this reopening play, and really a lot of lack of good investment in procuring those commodities over the last 10 years because they've been in a bear market. However, technology could derail that. We were talking about the idea that solar panels, as fast as they're improving, the cost of producing a wattage of energy is dropping substantially every 18 months, kind of like that Moore's Law with technology, right? There's still another problem, which is the batteries. And the batteries, despite all the rhetoric of being very environmentally friendly, they are once they're created, but to create them takes a lot of carbon and energy use to mine the lithium out, and there's probably not enough of it for everyone to be on these batteries, and the batteries are not there as a good store of energy. Texas is an example on what happened there. But those two are improving, and there are companies that are trying to create synthetically lithium. If those things all line up over the next few years, then energy's got a serious headwind to it.
Right, that's just one of the examples of how technology, once you get past certain thresholds, can really make a dramatic impact.
So we think that technology story long term is still there, but we are moving to a more core position to see what is happening, because you notice the S&P 500 is back up in the middle. All the growth, all the technology is back down below, while value, especially in the small cap, mid cap area, are near the top. So
when we think about inflation, we still see gold though down at the bottom.
How does that I think a lot of people that are trying to hedge their dollar risk have gone to what is hot right now, which is Bitcoin, and we've talked about the technology there. Gold has value in and of itself because you can always make it jewelry. Bitcoin is certainly solving the problem that the dollar has, which is you can't expand it infinitely, and that's good. And you can transfer it digitally, which in this economy is very important. So I think a lot of that technology is catching the flow that would have been going to gold. What I see long term is probably a merger of these technology with precious metals, but there's a lot of good things that are coming out of the Bitcoin technology as a ledger system and transferring and moving. So we still think it's there. I just don't know that it's really going to be the final solution to currency that many of the people that are promoting it. So then. Next
What
week,
is this that you put up here?
So
voting. I thought we were past the elections.
We are, thankfully, and we haven't had to talk about politics
I know.
other than what the government is doing. Not, I don't want to go back to the election time, that's for sure.
So what are we going to vote for?
So what are we voting for? So getting some audience participation. Next week, I have enough information to either do the bear case for China.
A lot of stuff happening in China in the news.
Demographics and other things that we could go over. Their market is not doing well year to date, which I don't think that's captured in the headlines here.
And we read today that the Chairman Xi has removed the app for Ant.
Yes.
So
Alibaba.
Or
Jack Ma, we talked about some of the things, and he was
hiding.
hiding. He's back. But yeah, there's a lot of stuff going on over there. Or should we cover automation? I mean, some of the stuff that's coming. I cannot wait to not fold a shirt ever again.
Well, when I look at these futuristic magazines that I read online, it's just amazing.
That seems like an oxymoron, futuristic magazine.
Right. Well, it's an electronic magazine.
There we
It's
go.
a magazine of the future, but it's today. But really, when you look to see, it's kind of like when we watched the Jetsons.
Yes.
Remember that show?
Well, in New Hampshire, they actually are a place that has the least amount of restrictions because they hope to get the flying car market started in New Hampshire. So there are cars that are being tested that can both fly and drive on the road. So I think they call it the Jetson Bill or something like that.
Well, let's have our audience vote and let us know by
Reach out to your
email.
service advisor and let us know, would you rather hear about automation or would you rather hear about China? And if we don't get enough votes, I guess we'll do an internal survey.
Right. So thanks again, everybody, for your participation today in our broadcast. You know, as always, what we're trying to do is to bring you analysis of data, matching that with our economic theory, so that we can really make better decisions on the portfolios, and you can make better decisions about your money. So is there anything else that we should add today before
we just ask that while you're, if you're watching it on YouTube, click that button below John. If you're not already subscribed, so that you're subscribed so you never miss out, whether it's a weekly market insight where we do take this deep dive to give actionable advice so they can make informed decisions or know the decisions that we're making for them, as well as the daily 3x3 where we recap the 3 relevant market topics in 3 minutes or less.
Well, thanks, Aaron, and I want to thank you, our audience, again for joining us, and we look forward to having you back either next Wednesday for our weekly Market Insight broadcast or for the daily 3x3 where you get the skinny on the day.
There we go.